A couple of weeks ago, another property in Houston, Texas was just foreclosed on. That's the 7th multifamily that was foreclosed on just in that area. For those of you in the space, this isn't a surprise because we've been hearing about the wave of debt that is coming due in the next couple of months. These are just signs confirming what's going to happen in a larger scale. But if you're just hearing about it, don't worry, because today I'm going to break down the events in 4 stages. From what started this, how did we get here, and what is going to happen. So sit back and relax and let's get right to it. Hello friends, I'm Adrian and welcome back to the channel. Okay, let's start with stage 1, how it started. Back in 2020, the Federal Reserve had to drop the federal funds rate to encourage economic activity. This effectively made money incredibly cheap to borrow. It resulted to making the floating rate bridge loan very popular. For those of you who are not familiar with bridge loans are similar to hard money lending. Bridge debt can lend with more flexible standards with interest-only payments, higher loan-to-values, and can even finance the construction cost. This brings us to stage 2, the buying frenzy. With these kinds of terms, a group can acquire property a lot easier compared to using a GSE loan where they have to raise more capital. Now, all of a sudden, there were a lot of players in the game. So what do you think happens when there's a finite amount of product, but there's a lot of money and a lot of people who wants to buy? You guessed it, the price gets bid up. Have a look at this chart. Both going in and exit cap decreased from Q3 of 2020 to Q1 of 2022. When buyers pay more for the same stream of income, that results in a cap rate compression. So going back to bridge loans have an adjustable interest rate that changes every month. They base the interest from an index called the Secured Overnight Financing Rate, or SOFR for short. After determining the SOFR rate, they add a spread to that. And the spread can be between 325 to 425 basis points or 3.25 to 4.25%. Let's move to stage 3, the turning point. As you can see, from April 2020 to March 2022, SOFR was around 0.04. But in October of 2023, the SOFR rate is now at 5.3. Then add to that the spread. That means borrowers are borrowing north of 8% on their loan. So you have a higher cost of borrowing, but projections of income is declining. According to CBRE, the shelter component of the Consumer Price Index, or CPI, has been steadily declining, which is a direct reflection of actual rents declining. Most passive investors are feeling the effects of this because operators have not given out any distributions. Operators now have a property that may have little to no cash flow. The only hope is to refinance or sell. But here's the problem. 1. As of Q3 2023, cap rates have now decompressed. 2. Loan-to-values have now decreased. That means borrowers would have to raise more capital. And 3. You have a steadily declining rent growth. So cap rates are increasing and income is decreasing. That results in a lower property value. The main problem here is that the operators can't sell or refinance without losing some or all of the investors' money. This brings us to the final stage, stage 4, the outcome. Again, this isn't news. Everyone knows what's about to happen. In fact, investors are preparing for one of the biggest buying opportunities in history. There are several private equity firms already raising capital to purchase distressed properties for a fraction of the price. There's an example in the article where a property was purchased for $41 million, but the seller paid $107 million in 2014. The paragraph below highlighted what we talked about in this video. Many property owners with floating rate debt may also feel pressured to sell at markdown prices because they are unable to refinance at today's higher rates. Now, before it gets to this point, a term is starting to get used more often, and that term is a capital call. Capital call is simply the operators asking for more capital from the investors other than what is already committed to the partnership or fund. More often than not, capital calls are rare because technically they're only used when unforeseen or unplanned events occur. I get it, it is tough when it happens, but it is only during tough times when trust is truly tested. So if LPs trust on their GPs, then have that open communication with them. Have the operators lay out the current situation and what is the plan to move forward. GPs and LPs are not on opposite sides in this. So you're probably telling yourself,
wow, this is horrible. I'll probably stay away from investing in real estate for a while.
I wouldn't blame you for thinking that way. But what about if you're currently in a deal right now? What should you do? I would recommend to reach out to the general partnership team. Ask about the latest updates about the property. I would also review the capital stack because that will determine how much risk you're exposed to if the worst scenario ever happens. So if you're unfamiliar of what the capital stack is, go ahead and click or tap the screen right now, where I quickly explain the capital stack and how it determines risk.